Welcome back to EDS, and in this video I'm going to show you how to turn volatility in the market into profit step by step. This is suitable for all size accounts, but especially if you have a smaller account or if you're a beginner, this video is definitely for you. Even if you have a larger account, it's still worth you watching. You're just going to be able to get a higher return on your capital. So the first thing that you want to do is we're just going to quickly go over what we're doing here at a bird's eye view. So we are going to be writing options contracts on futures contracts, and the reason why we use options, specifically why we're going to write the contracts, is because it allows us to get a very high probability of success. And the reason why we write the contracts on futures contracts is because futures uses span margin. So our buying power requirement is based on span margin, and span margin allows us to be very capital efficient, and this is what is going to allow us to get a high return on capital. So with that in mind, you want to pull up a futures watch list like this that have options available to trade on. If your broker doesn't provide this information natively, then just take note of these ticker symbols and make your own custom watch list. Now we want to use volatility. Okay, so what we want to do is get IV rank up, and we want to order our watch list from high to low IV rank. Now the reason why volatility is important is because we are going to be writing these options contracts, which means that we are short the contracts, which means that we want to sell high and buy low. And volatility, or Vega, has a role on option prices. So when volatility or Vega increases, option prices increase. Okay, now remember, we want to sell high, so we want to sell when volatility is high and play the contraction. Now volatility is contracting most of the time in the market, so we can use this to our advantage. So IV rank lets us know where IV is on that particular underlying relative to itself over the last year. So if IV rank was at 0, that means that IV is at the lowest point that it's been over the last year. If it's at 100, it's at the highest point. So it allows us to kind of put IV into context relative to each specific underlying, or with respect to each specific underlying. So now that we've got this watch list up and we've got everything ordered, what we want to do is we want to pick an underlying that, number one, will complement our portfolio, keep things nice and diverse, and number two, it needs to have an IV rank of at least 30. Anything with an IV rank of over 30 can be considered high. Over 50 can be considered very high. And also these products, these futures products are very, very big products. So, and they're all different sizes. So depending on the size of your account, you may or may not be able to trade anything or everything. So if you have a very small account, I would personally stick to currencies. If you have a larger account, by all means pick whatever you want. Your buying power requirement will range quite wide depending on what underlying you pick. The span margin takes into account the absolute IV level, which we can see here. The lower the IV, the less buying power that will be required. But then again, the contract multiplier plays a part as well as the actual price that the underlying is trading at. So just as a general rule of thumb, if you have a small account, stick with currencies. If you have a large account, feel free to trade whatever you like. So with that in mind, at the top of the list, fortunately we have a currency here, which is the Australian dollar futures, with an IV rank of 73.2, an absolute IV level of 10.2%. So what we want to do now is pull up a list of expiration dates for that underlying, and on the left we have the option expiration dates, and next to it we have the futures contracts that correlate to those expiration dates, because not only do the options contracts expire, but also the futures contracts expire. So you don't really need to worry too much about this, because any good broker will automatically format this information for you in a similar way or in the same way. So February 7th, March 7th option expiration dates line up with the 6AH5 futures contracts. April 4th, May 9th, June 6th, April 4th, May 9th and June 6th expiration dates on options align up with the 6AM5 contracts. Then you've got U5 contracts thereafter. So You don't really need to worry too much about the futures contracts. Just know that they do expire, and futures contracts, your positions will need to be rolled if they're getting too close to expiration, but you don't need to worry about that at this point in time. So what we need to keep in mind is the option expiration dates. That's what we're focusing on, and the expiration date that we pick needs to be between 30 and 60 days out in time. So we've got an expiration date here that's 43 days out in time, March 7th. So we're going to open that up, and now we are presented with the options chain. Very quickly, we have calls on the left, puts on the right. This orange horizontal bar shows us where the price of the underlying is with respect to the strikes that go down the middle. This vertical orange bar shows us what the expected move is of the underlying over the next 43 days. We have our standard deviation levels here, denoted with these blue dotted lines, and we also have positive deltas on the call side and negative deltas on the put side. So we are using span margin because we're writing contracts on futures, and that's going to give us a high return on capital. So now we need to make sure we get a high probability of success. So when we are writing futures contracts, when we are writing options contracts, what that means is, so let's say, for example, if we were to just sell this contract here at the 0.61 strike, what this now means is that we want price to stay away from this contract. We want price to not breach this contract, and we want this contract to stay out of the money. Okay, so with that in mind, the further out we go, the higher our probability of success will be. However, the less premium we will collect, and the lower our return on capital will be. So we want to have a high probability of success, but we also want to balance that with a high return on capital. So how do we know where to sell our contracts? Well, the first thing that we're going to use is this expected move indicator. If your broker displays this, it's fine. If it doesn't really matter. But you have an expected move, and we want to basically be outside of the expected move. Okay, and we want to be in and around the one standard deviation levels. Again, your broker may or may not display it, but it's fine. Every broker will and should display your deltas, and both of these things will line up with a 15 to 20 delta. So we've got a 15 delta on the call side. So if you sell the 0.65 strike here, and we have a 14 delta on the put side, we sell the 0.605 strike, and as you'll notice, all three things line up perfectly. We're in and around 15 to 20 deltas, we're outside of the expected move, and we're in and around the one standard deviation level as well. And what's basically happened here is we've created a range for ourselves, and we want price to stay within this range. And if price is within this range at the point of expiration, which is in 43 days time, we will keep 100% of the premium that we collect up front. And what is the chance of that happening? So in the bottom left corner, we have our POP, which is probability of profit. And that is our probability of making at least 1 penny on this position at the point of expiration. And we've got a 75% chance of that happening right now. But what if we don't want to wait all the way to expiration? 75% is super high as it is. Anything over 50% is considered a high probability trade. So 75% already is a super high probability of success. But what if we don't want to wait all the way to expiration? What if we want to get out of 50% of max profit? Well, we have this P50 number here, and it's not displayed for futures. For equities it is, but basically your P50 is going to be about 10 to 15% higher than your POP. So, in and around 85 to 90%. Okay, so we've got probabilities of success of between 75 and 90% upfront. That's before making adjustments. That's before taking into account that implied volatility is generally overstated compared to actual volatility. So these numbers will actually be a little bit higher. So we don't even need to include that, right? Assume it's a bonus. So we're looking at probabilities of success of between 75 and 90%. Very, very high probabilities of success. Now, what about our return on capital? So the amount of money that we're going to make is dependent on the premium. So how much premium are we going to collect? Well, we have this number here, our mid price, and this is our price per share that we are going to try and get filled at, which is 0.0031. Now, it might seem like a small number, but remember, futures are big products. The contract multipliers are in the hundreds of thousands. But you don't need to worry about that because your broker will automatically take care of that for you. So once it has been multiplied out by the contract multiplier, we arrive at this max profit number here, which is 310. This is in dollar terms, and this is what would get added to our cash balance by our broker at the point of getting filled on this position. So $310 is our premium that we would collect up front. And our buying power requirement is $720. So we collect $310 and our broker is going to hold $720. As we can see, this is a very nice and high return on capital with very high probabilities of success. But what if you wanted to get even higher returns on capital? Just before I show you how to do that, we also have this data number here, which is $10.99. This is how much the contract will decay in value every single day. Essentially, this is your P&L every single day, $10.99, assuming all else stays the same. Okay, so now what if we want a higher return on capital? Well, we can just be a bit more aggressive. Let's just say we go to 20 delta. So that's 21 delta there, 19 delta there. If you notice, we're still just outside the expected move, where we all 3 points of confluence line up. We're in and around the 1 standard deviation level. The deltas are in check as well. If we look here, our net delta is negative 0.03, which is near enough delta neutral. That's absolutely fine. But now what you'll notice is our premium has increased. So we collect 470 up front. Our buying power hasn't increased that much. It's 815. So we collect 470 and now our buying power requirement is 815. So our return on capital has now increased. Our POP has decreased slightly by 7%. However, it's still at 68%, so we've still got high probabilities of success, but we have an even higher return on capital now. And generally speaking, well, not generally speaking, this is how it is. Basically, the more risk you take, the more reward you get, and the more money you make. You just need to make sure you can stay in business and don't blow your account up. Make sure you manage risk correctly, and it also helps if you know how to manage and make adjustments as well. If you want to be even more aggressive, you can go to the 30 delta, go to the 30 delta on either side. I mean, we'd collect $820 up front here. Buying power requirement is going to be $893, so we're almost getting a 100% return on capital. And remember, this is in a 43-day period. This is not yearly. This is in 43 days. Okay, so this is how you can balance out your return on capital with your probabilities of success to whatever you want it to be. You can go all the way to at the money if you wanted to. You collect 1.6k up front and your buying power requirement is going to be $934. So super high returns on capital here, but obviously your probability of success will suffer in turn. However, if you were to put a position on like this, you probably want to get out at, say, 25% of max profit. You wouldn't really necessarily want to hold to 50%, or you definitely probably wouldn't want to hold till expiration. But this is the core of what you need to do, and you need to do this as many times as you can, have as many occurrences as you can, and just let the odds play out in your favor. Now, in order to do that, you need to make sure you know how much buying power you should be allocating to your positions. And in order to know that, we've created a free position sizing template. The link is in the description. Everybody can get a copy. Just click the button and it will take you over to the spreadsheet. And the way it works is you enter in the size of your portfolio. So say if you have a $10,000 account, you then enter in whatever the current VIX level is. So say if it was 17.4, everything below will then be automatically calculated for you. Just as long as you use this to form the backbone of your portfolio, you will be absolutely fine. It will tell you the maximum amount of buying power to allocate to defined risk positions, undefined risk positions, how much of your portfolio you should allocate to short premium strategies, the minimum amount of your portfolio to allocate to undefined risk trades. What we went over today was an example of an undefined risk trade. Sometimes it's called a naked trade. Undefined, naked, it's the same thing. But as long as you follow this, you'll be absolutely fine. If you want to learn in more detail about what we do and how we do it, click this button here. The link will also be in the description, EDS Premium. Get yourself signed up, and inside you will have access to our portfolios that will allow you to see the positions that we're placing, how we manage risk, how we make adjustments, all in real time. There's a full course as well, so no prior knowledge is required. We will teach you everything that you need to know from start to finish. If you get stuck, it is a private community, so you can speak with myself directly or with other like-minded individuals. And there's also a 100% money back guarantee. So once you've been through the full course and followed some of our trades, if after 6 months you haven't seen results or you're not profitable, then we will work with you for free until you are, or you can simply request a full refund. So it's completely risk-free. It's $9.99 a month to join right now. The price will be increasing. However, once you're in, the price is locked in for you for life. So whatever price you get in at, that's the price you pay forever. So the earlier you get in, the more you're rewarded, and the price will just keep on increasing after every wave of members join. So the aim of EDS Premium is to teach you the skill. We don't want to keep you dependent on us. This is not a signal service. We do give you an insight into some of our portfolios, but we are not trying to keep you dependent on us. We are giving you the skill. We want you to be able to take it with you for the rest of your life, and once you have the skill and once you know what to do, nobody can take it away from you. And we aim to get you to a point where you are completely self-sufficient within 6 to 12 months. It just depends on how much time you put into it. You are always welcome to stay and be a part of the community, but 6 to 12 months you'll be good to go. So with that being said, I will see you guys on the inside.